The world is bracing for impact as tensions escalate further in the Middle East, a region that supplies close to 1/3 of the world's crude oil. Heightened volatility in oil prices is impacting global fight against inflation, destabilizing the foreign exchange market and prompting financial authorities to ready preemptive measures. And as multiple conflicts cast dark clouds over the global economy, Bitcoin miners are anticipating the effects of the halving season. Middle East tensions and the economy. That's the topic of our discussion today. And joining me now is Shim Myungkyu, an associate professor of economics at Yonsei University. Welcome to the program.
Thank you for having me.
We also have Kim Hwagyun, professor of banking and finance at Texas A&M University, joining us via Zoom. It's always a pleasure to have you with us.
Same as well. Thank you.
Professor Shim, let's start with you. The world is bracing for a sharp uptick in oil prices amid signs of a widening conflict in the Middle East, but we're yet to see a big surge. Why is the fresh Iran-Israel conflict having a limited impact on oil prices so far?
Before discussing the reason why the impact has not yet fully affected Korea, let me give you some numbers. Both Brent and Dubai crude oil prices have reached $90 per barrel, which is about 5% higher than a month ago, which is a very high number. But as you pointed out, the fuel price in Korea has hardly increased during the same period, meaning that the change in the oil price has not yet spilled over to the Korean economy. I think there are two reasons on this issue. First, while the escalation of Israel-Hamas war to the greater Middle East area can create greater oil supply disruptions, its impact can be limited as we have experienced during the last 2 years, mainly because of low dependency on the fossil fuel due to the increased demand for electric car, whose share has increased to 10%, and the emergence of hybrid car, which reduces the demand for oil. And the second reason is because it takes time for the oil price to affect Korea, especially the domestic food prices. Oil is purchased unless several months before it is sold to the consumers. And so the current oil price hike might not be reflected at this point. So what we need to do is to watch more carefully to track the environment surrounding the oil market.
The oil prices have rather softened this week, even slipping further down at one point. So it seems like Iran's attack did little damage so far, not impacting the global oil supply, at least not yet. And as you've pointed out, it will take some more time for the impact to reach South Korea. But markets are still on edge, and we'll have to see if this is the calm before the storm. Dr. Kim, one of the biggest fears right now is perhaps Iran's possible closure of the Strait of Hormuz, a key waterway for global oil transportation. In fact, a top Iranian commander has said Tehran would review closing the strait if, quote unquote, the enemy comes to disrupt Iran. Well, some are going as far to say that the world must prepare for a repeat of the 1973 oil crisis. What's your forecast of where oil prices are headed?
Well, the potential closure of this strait by Iran may indeed impact global oil markets because a substantial portion of world oil supply pass through this strait. Having said that, we have a lot of other options nowadays. And also, if this indeed happened, and therefore for a substantial amount of time, we will experience the difficulty of distributing oil throughout the country, then I think the other countries that produce oils probably will start producing the oils much more clearly. Then that actually can soften the price. And in fact, if you look at the price as of now, like you mentioned earlier, per barrel, I think now it's around like $82. Actually, in fact, it actually dropped. So clearly, supply issue is one thing, but the demand is another factor that affects the oil price. And for some reason, the demand seems to be somewhat smaller than we expected. And some of the analysts actually forecast are saying around like $80 is the reasonable amount, the price. And others are saying, like you said, probably over 100 is going to be the right price if this happens. So we will see fluctuations between 80 and 100 bouncing back and forth. And if indeed this type of things, which of course we shouldn't, but I think but if happens, then I think the short-term price volatility will be very high, up to probably 120 or something. But once this continues to increase, then I think, other countries will eventually kick in and start producing more.
Well, nearly 1/6 of global oil supply is transported through the Strait of Hormuz, so any disruptions there would, of course, mean a super hike in oil prices. So the Hormuz, certainly a critical element to watch out for, along with Israel's possible retaliation. But as you've mentioned, demand remains weaker than expected. And analysts say that we will need a bigger and further escalation in the Middle East for oil prices to actually rise to the triple digits. So we'll have to continue keep watching very closely. And staying with you, Dr. Kim, high oil prices obviously put upward pressure on inflation and are expected to significantly impact global efforts to bring the prices down. Does this mean a further delay of rate cuts by the central banks of major economies? And in your view, would we be able to see rate cuts in the latter half of this year?
Right. I think that's a possible scenario. And clearly, high oil prices can indeed exert significant upward pressure on inflation, because this is a classic example of cost-pushy inflation shock. Having said that, again, the degree of this affecting the other commodity prices and also the expectations and sentiments, which is a key part of the managing of the inflation expectation from the Fed and other central bank. Therefore, in that regard, there's a chance that the Fed is going to use this and then also closely watching this to make decisions about the timing of the lowering the Fed funds target and also the target interest rate for the short term. So that's going to be something that we have to keep watching. And if you look at the Fed futures now, unlike what we had in about like 2 months ago or a month ago even, now I think the chance of the lowering the target interest rate in case of the U.S. Pulled back, and probably sometime in July to September, now the possibility of lowering down by 25 basis points is about 40–50%. So it used to be about 80–90%. So clearly we will see this as of now about like, decrease the chance of the lowering the interest rate. But as long as there's not much things going on, then I still think that about September and also one more time, probably twice, we will see some interest rate going down. Having said that, if the inflation, not just the inflation shock, but I think the oil price and other type of things related to this war affect the economic recovery of the global economy, then I think that also can facilitate lowering the interest rate, actually. So there's some chance.
So in your projection, we may be able to see interest rate cuts towards the end of this year. Zooming in on the impact on domestic markets, Professor Shim, the Middle East tensions have pushed down the Korean won to record lows, posting the biggest slide in over 17 months this week. But it rose slightly against the dollar today after the Finance Ministry and the Bank of Korea weighed in, hinting at taking steps to curb FX market volatility. What's your outlook for the local currency? Would we continue to see won depreciate?
Before I give my answer, let me first point out the number to see how serious the current situation is. Compared to the US dollar, Korean won has depreciated by about 7% during the last 4 months and has depreciated by about 12% during the last 1.5 years. Given that the timing of won depreciation almost coincides with the timing that the BOK started raising the policy rate, I think there is a high probability that Korean won can depreciate further. This is because the interest rate spread between Korea and the US, which is one of the main sources why Korean won is depreciated, could be high for longer than we have expected. And recent signs on the inflation rate in the US alarm that the Fed will not lower the interest rate very soon, which is a little bit different from Professor Kim's view because of the continued concern for the inflationary pressure. And the problem is that the BOK cannot increase the interest rate to close the gap because of various concerns on the current economic situation. Huge household debt as an example. In addition, strong dollar is not specific to Korea, and so the government's effort to stabilize the exchange rate market will not work that effectively. So what I expect is that the $1 exchange rate will increase maybe for a while.
The Bank of Korea Governor Lee Chang-yong reassured investors yesterday that the bank has sufficient tools to stabilize the foreign exchange market and that the recent won volatility is somewhat excessive given Korea's market fundamentals, but various factors indicate that we may continue to see the won depreciate further for a longer period of time. And staying with you, Professor Shim, in the face of mounting unease about a substantial hike in oil prices, the government has decided to extend fuel tax cuts for another 2 months until the end of June. How much would this help? And do you expect Korea to reach the government's goal of 2% range inflation in the latter half of this year?
And if you look at the number, the current tax on gasoline is 615 won per liter, which is about 201 or 25% lower if the policy is abandoned. Given that the food price has soared a lot during the several months, I think it is certain that not abandoning the current policy will be helpful for households since it lowers the transportation costs, which can directly improve the consumer's welfare. But I'm not sure if that will be that helpful to stabilize the inflation rate as we want, so that it helps to achieve the inflation target of the BOK. So if we look at the core inflation rate, which measures the inflation rate after excluding food and energy products, has been stable at around 2.5% this year. And this year, so this figure is the lowest level since 2022, implying that the price level, excluding the energy products, has stabilized a lot during the last 2 years. So given that the price level has become already stabilized a lot compared to before, we can expect that the effect of the tax cut will be somewhat limited. Rather, I would like to make a cautionary note on the further tax cut. As we know, the current situation on the government debt is not that good. And given that the inflation rate can increase further by increasing the government debt, which is already high. And I think this can be problematic because the inflation can effectively lower the burden of the government so that it can give more room for the inflation rate to increase or not to decrease further.
So you think the effects of fuel tax cut will be limited in bringing the prices down, and what you think is a more important consideration is the government's mounting debt. Now, Dr. Kim, despite the heightened Middle East risks, the Trade Ministry expects Korea to see continual recovery in exports this month. What factors are contributing to this confidence?
Probably the biggest one is the global economic recovery. So I think the overall economic sentiments of like around the world, I think seems to be better than last year. And also some of the key areas that South Korea is exporting a lot, I think, on such as like semiconductors and also like military products and also other types of the K-culture related stuffs actually are selling really well. So I think these kind of things definitely help contribute to keep just under the increasing the exports and also the diversified the exporting goods about South Korea for the last decade or two. I think make this type of the effect rather positive or a little more optimistic, I would say. And also the supply chain resilience, I think, is also one of the key factors. And after experiencing a lot of these issues and obstacles and the difficulties, lots of Korean companies, I believe, have been investing in making their supply chains a bit more resilient to shocks like this. So definitely this helps the Korean firms to export better. And despite the situations, and after all, if this type of the instability continues, then anyway, people around the world need consumption goods and things like that, and we can sell this kind of things because it's a good the chance to sell when also there are shortages of the products and things like that. So the manufacturing countries have this type of edge on negative shocks like this as of now.
Professor Shim, let's wrap things up by talking a little bit about Bitcoin. The next Bitcoin halving is expected to occur this Friday or Saturday. What exactly is Bitcoin halving and what impact would it bring?
Bitcoin halving is a technical event that happens every 4 years to keep the value of the Bitcoin. In particular, it is the timing when the rewards for Bitcoin miners are cut in half, which will reduce the pace at which new coins are supplied to the market. And this helps to control the supply because new supply becomes lower and lower over time. Currently, new Bitcoin that each miner can obtain every day is 900, but after the halving, it will become lower to 450. And I can point out several mixed impacts on the Bitcoin market. First, it makes the coin to be more scarce, which can potentially increase the price level as a lot of miners can expect. Second, it lowers the profitability of the miners, which can curb the supply more because miners with low productivity might exit the market. I think it can create the tension in the market. Lower supply can increase the price, but if the miners who exit the market sell their coins, it can have negative effects on the price, and whether the price of the Bitcoin can increase or not will depend which dominates the other. And given the observation that the hike in the price of Bitcoin with the Bitcoin halving has decreased over time, I think the latter effect would become more greater than before, which gives us the forecast that there would be a smaller increase in the price of Bitcoin than we have experienced before.
And while Bitcoin's halving, on top of Middle East concerns, is keeping investors on edge, Hong Kong regulators approved the launch of spot Bitcoin and Ether exchange-traded funds, or ETF. Dr. Kim, how do you foresee the future trajectory of Bitcoin considering all of these developments?
As Professor Shim mentioned, well, the core of this Bitcoin consists of like these miners' activities, and also they're also working as like a marginal investor because they actually have very positive view about the Bitcoin. The second group also key, I think, is the traders who actually mainly just get capital gains and that's their own stuff. And Bitcoin is very speculative asset without much fundamental value other than this transaction network. And therefore, this type of the ETF introduction and also the wider band of the investing grounds is going to be really good news. Clearly, compared to about 2-3 years ago, the recognition about the Bitcoin or Ether and also the trading platform has been much better, I think, grounded, including the US, Coinbase, and all other countries. And South Korea is also one of the leading countries in that regard. So clearly, the one step closer to going to or getting into the major investment platform is good news. And once this is going to become more like very natural, like, assets like stocks and bonds in trading, and also the exchanging across stocks, bonds, and the bits and the Bitcoin or Ether, then I think this is going to clearly increase the price, because that keeps just they keep making the new investors to getting into the system. So I think overall it's very good news, especially given the nature of the Bitcoin.
Well, some reports say that Bitcoin halving will trigger billions of dollars in losses for some, while some optimists stress the fact that Bitcoin prices may increase dramatically in the months following the halving. And we also have to factor in the rising geopolitical risks. So quite a tumultuous time expected ahead for miners and investors as well. And you've expressed optimism for Hong Kong regulators' ETF approval. And certainly Hong Kong became Asia's first to accept the cryptocurrencies as a mainstream investment tool. So it'll be definitely interesting to watch how markets unfold from this point on. Thank you so much, Dr. Kim and Dr. Shim, for sharing your perspectives with us today. We appreciate it.
My pleasure.
Thank you.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.